Good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Tuesday, September 7th, 2021. And our top stories today, a common sense journey to DC retirement income and clearly evaluating ESG and sustainable investment options. Well, joining me now to discuss this and a lot more is Greg Fox. He's head of retirement income for Aeon Investments. Greg, it's great to see you. Thanks so much for joining us on the program this morning.
Thanks for having me. I appreciate it.
And we're going to talk about a common sense journey around defined contribution retirement income. Let's start out with, why is now the time for employers and employees to consider their retirement income strategy and their journey?
Well, first of all, let me say I love the question. And the reason I love the question is that you're not asking me, is now the time? You're already in agreement that now is the time. So we've acknowledged now is the time.
Absolutely.
The DC world, for the most part, has been focused on convincing, or in some cases, even tricking people into saving more, hopefully enough for retirement, right? The second struggle that we've been facing is getting people to invest those savings appropriately, having enough risk early so their money grows, de-risking later so that they don't experience a big loss at the worst possible time just when they're about to retire. And just to say it, of course, those things are the right things to focus on. But let's say you and I wake up tomorrow magically in a world where we've taken care of those couple problems. There's still a third big problem left, and that's people are more reliant on their defined contribution savings to pay for their retirement than they've ever been before. It's less common for people to have a defined benefit these days. There are questions around the future viability of Social Security. And at the same time, people are living longer and costs in their retirement are higher. So the responsibility for coming up with a plan to spend down their savings, even if it's enough savings, has shifted to the individual. And they have no idea how long they need to make that money last or what the markets will do as they're managing down their money. That's a daunting task for everyone except fortune tellers and psychics. Even actuaries and professional money managers struggle with those issues individually. And how can we expect the average person in a retirement plan to do that on their own?
Yeah, I like that you bring up the soothsayer and the storyteller and the person who can predict the future. Unfortunately, none of us can do that, and so we don't know what bumps are going to be ahead. Let's talk about evaluation of these products. And you and the team at Aeon, you have a very deep investment team, a lot of skilled experts who've reviewed and evaluated lots of these products. How do you break this down for both employers, so employers who sponsor 401k, 403b, governmental 457, and also their employees? How do you evaluate all these different products?
Yeah, great question. So the temptation is to focus on the products first. There are all kinds of new solutions that are out there, more still coming to market. And these providers that are selling those solutions are making the rounds, creating awareness, talking to plan sponsors. We get a lot of questions from our clients around whether we like a certain product. Is it buy rated by Aeon? We find that it's much better to reframe that conversation and first focus on what is being solved for. There are guaranteed solutions and there are non-guaranteed solutions. There are options that live inside the plan. There are options that live outside the plan at the end of the plan. Opt in, opt out, choices that serve specifically as solutions that are geared toward retirees and solutions that bridge the gap between people who are saving and people who are spending. So narrowing in on the right sets of those trade-offs will better allow employers to meet the needs of their former employees. And then those retirees will ultimately go through the same framework. Do I want guaranteed income? Do I want to choose the allocations to the different solutions, or do I want to have a professional make those allocation choices for me? It's the same kind of the process, but it happens twice. And that's why offering one spending solution in the plan may not be enough. It may not fit, the needs and circumstances of everyone individually.
Yeah, all these plans I always think of them as ecosystems, right? We all live in a different ecosystem. We all have our own individual needs. I guess one of the questions I have as a follow-up is around the regulatory environment, because we've always seen that kind of where the red flags kind of come up, where I'm a fiduciary, there's no fiduciary safe harbor. if I select this, I'm on the hook for not only today, but tomorrow on that guarantee. So I don't know what's going to happen. Back to our fortune teller, we don't know what's going to happen 20 years from now with that insurer. Does the regulatory environment support the use of retirement income today, right now?
Yeah, it does. So to most directly answer your question, there's no expectation that fiduciaries are going to have a crystal ball. You can only make a decision informed on what information is available to them in that moment. And as long as they go through the prudent process and requirements and guidance that are out there as part of the regs, fiduciaries should feel really comfortable with making decisions around guaranteed income. The other thing that the current regulatory environment supports through the passage of the Secure Act at the end of 2019 is requiring annual disclosures that translate someone's income balance into an ongoing stream of income. So I'm hopeful that if nothing else, this will help to shift people's mindsets away from thinking about account balances and encourage them to start thinking about their savings in terms of ongoing income.
Yeah, and it sounds like a great strategy. Let me ask you this question. You've sat in a lot of these committee meetings. Is there anything missing from the current conversations? What are the current conversations like, and what could we do better as, not necessarily an industry, but as fiduciaries of retirement plans to address these issues?
Yeah, well, we're trying to nudge the market as much as we can. I mean, hopefully this interview is a good nudge for employers who are watching. I think what's missing here a little bit is the motivation. Kind of like climate change, the issues surrounding DC retirement income have historically been a tomorrow problem. There have been a handful of reasons that employers point to when explaining why they haven't offered spending solutions yet. The most common reasons are fiduciary concerns, which you've already cited, administrative concerns and complexity, lacking demand from their employees. But there haven't really been consequences yet for staying on the sidelines. So for the employers that aren't offering spending solutions yet, nothing's happened, right? To the extent that those employers continue to remain on the sidelines, we're going to see entire generations of people run out of money in retirement. And unfortunately, by the time that actually happens and it becomes a today problem and not a tomorrow problem, it's too late.
Yeah, it absolutely is too late. And so how do you, I am not a big fan, but I want to get your perspective on this. You can't scare people. I think when people get scared, there's a resistance. So how do you nudge people? I mean, is it just education by colleagues, your colleagues, people in the industry to say, here's the reason why. And here's, you make a really good point about employees not being able to retire. And here's what that can mean long-term for your employment base. You could have attrition. You could have people going all over the place. Those are real problems that you could have. But you probably don't want to go through the scare tactics because that may not work. So I guess my last question is, how do you nudge employers in a good way and then also their employees to consider this? And I know you mentioned the illustration that's coming out from the DOL or the requirement, but how do we nudge people along?
So the DOL illustration is a really good nudge, right? That's required. All plans are going to have to do that. And hopefully participants are paying attention to the communications and they're seeing that and they're thinking about it. That can create demand at the employee level, which hopefully also additionally kind of rolls up and creates demand at the plan sponsor level. The other thing that we're doing on the consulting side is making sure that this is a front and center topic. We're talking about this with as many clients as we can. We're educating, which is obviously an important way to do it. And while we don't want to create too much fear, I think to some extent, scare tactics are warranted here because that's just the reality of the situation. So I think a little bit of fear is okay. Maybe too much just causes paralysis and people kind of don't want to make decisions there. But, I think education, I think the new communications and required disclosures are going to go a long way. Lawmakers certainly seem to be on the side of understanding that this is an issue and income is an important way to solve for it. And so just doing all those things and continuing to beat that drum and hope people hear it.
Yeah, I think they are. And I think that the work that you're doing at Aeon, other consulting firms, the media that covers this space, I think a lot of people are bringing this up. And I think I'm hopeful, like you, that the new DOL requirements help move the needle. Greg, we're going to have to leave it there. And greatly appreciate you coming back on. And when we come back, we'll talk about the ESG Dashboard. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. And now we're going to talk about evaluating ESG options. And joining me now to discuss this and a lot more is Russ Ivanjak. He is the Global Chief Investment Officer at Aeon Investments. Russ, great to see you. Thanks so much for joining us on the program this morning.
Jeff, thanks for having us. Thanks for having me.
Yeah,
really appreciate it.
And it's great. I mean, yeah, it's great to have you on. And we just talked about in the first segment with your colleague Greg Fox about retirement income, but that's an important topic. But so is ESG and the evaluation. Let's talk about how do you and the folks at Aeon Investments really take a look at evaluating these very unique and different but yet important products.
Well, ESG is probably at the forefront of everything we're doing today. So as we are looking at investment managers and their strategies, we are looking at it really from start to finish, how they incorporate all ESG risks into their process. That it's in the analysis of the securities and it's how they put portfolios together. And we rate firms on the ESG factors from advanced to integrated to limited. So those are the three rating categories. And we're moving in the direction of only using firms where we rate them as integrated or advanced and not using firms who have limited skill sets in taking into account ESG risk factors.
Russ, where does this ESG, I should have asked you this first and my apologies, but where does ESG and sustainability sit in the priority or the hierarchy of importance for institutional investors with whom you and your team at Aeon are working?
It is the hottest topic. It's number one on the agenda. Now, the caveat I'll give is that if there's a major change going on with a program, they're rethinking, their time horizon or their objective. But if their program is, I'll call it more steady state, the next step in their evolution is incorporating ESG, and more importantly, thinking about impact investing and sustainability. So how can their assets not only do good and do well? And this is across the board. It is public and corporate pension plans, it's endowments and foundations, it's insurance companies, and it's in the defined contribution arena and across the wealth market. So everybody is looking at it. They're first and foremost trying to figure out where they are, and then how do they evolve their program, and what are the next steps they should be taking. Obviously, we have different phases people are in, but it is the hottest topic with our clients today.
Yeah, everything I read, both on the retail side and the institutional side, really supports what you're talking about. I mean, everyone, and you can see this through the asset growth. I mean, you have to look no further than the $1 trillion of asset growth that we've seen in a relatively short period of time. Russ, you mentioned the ratings. Let's talk about metrics, because I have to think, as you know, I've come from the defined contribution world. That's where I started my career, and very familiar with evaluating those type of investment options. And there's a lot of details, right? There's beta, alpha, all these different things that you look at. What are some of the metrics? And I know you're going to talk a little bit about your dashboard, but what are some of the metrics that you look at to measure these types of investment options?
Well, the metrics we're looking at, and it really goes into the heart of the E, S, and the G. So one is the environmental aspect. That is really that's the newer component. So looking at energy transition. It is looking at carbon footprint from a portfolio's investments. There's the G, which is governance. We've been looking at governance for decades, but it's really just raising the bar, and it is far more important today than ever. And then the last is the S. The S is, that has been historically some social components to it, but now this is really focusing on all stakeholders. How can there be a positive impact for all involved with a company? So it's what is that impact they're having with their communities? It's how do you provide better access to financial services to, let's say, lower income communities. So it is across the board, making sure that the E, S, and the G are all working.
And Russ, just to kind of follow up on that, in a typical non-COVID world, you'd be doing a lot of due diligence. Oftentimes, it's either done through conference call, it's done through Zoom, or it's done on site. What type of due diligence do you have to do to look at some of these factors? I mean, I don't think you're traveling just yet, but in a non-COVID world, what would that look like?
In the non-COVID world and in a COVID world, the first part is our quantitative screens. So obviously we have databases we pull the information from on managers, what they're doing, what's their investment process, what's their portfolios, what do they look like. So we do all the quantitative screening. Obviously, we send them extensive questionnaires for them to come back to us on. So it's what have they done? What are they doing? What's the capability of their staff? And then it's the in-person meetings or Zoom meetings where we really dig in and make sure they have a true understanding of what they're doing, that they're not just talking the talk, that they are actually understand the implications of their investments. And importantly, we engage in that live dialogue, because some of the best opportunities out in the marketplace now are companies who may have not been, let's say, the best on the ESG factors, but they're improving their game. So many investment managers today are focusing on the companies that are going through the biggest change and will have the most positive impact. And you need to understand that, because when you see a name in the portfolio, you may say, what are they doing in this company? They've got a bad track record. And an investment manager can articulate saying, look, they've changed the board. They have a new C-suite in. Here's why we're investing in it. We see the progress. So it's not just looking at the data, it's both the quantitative and the qualitative components that are very important.
And Russ, how do you convey this information to a fiduciary, to a board, to a group of trustees? I mean, you're the experts. Mm-hmm. They are not necessarily experts. So how do you take all this information and kind of compile it down so that I can check on my endowment or my pension or my defined contribution plan to make sure that the scores align with my investment policy and other important attributes for my program?
The key component there is a ESG dashboard that we've created. So it shows to our clients, both at a high and very detailed level, how we rate their managers on the ESG factors. So as I mentioned before, in firms we're integrated or advanced or limited. So what's your allocation to managers with those types of ratings from us? And then we can drill down. What's the carbon footprint of the portfolio? How do they rate on the governance factors? How do they rate in the social factors? And we can pinpoint where there may be a problem or what we believe is an apparent problem in the portfolio, and then dig deeper and even then engage our clients with the manager to understand the positioning. Quick example I'll give you is in fixed income. Lots of high yield managers will have exposures to energy companies. Obviously a bigger carbon footprint, but understanding why a manager has exposure to the energy sector and what they're doing with those companies and lending them money, frankly, to help with the transition to renewable power.
Yeah, I imagine that these stories or this dashboard can change over time. If you're adding investments, subtracting investments, holdings, fund managers, my recollection is that they're, it's buy and hold, but they might change over time what their strategy is. And so it's not only aligning the investment strategy, but also reporting out what that means in terms of these ESG and sustainable initiatives.
Yes, very much so. I mean, that's where we are engaging with investment managers on what they're doing with ESG to make sure portfolios are evolving. They know their risk factors. That one of our concerns was a manager could just hire an ESG team, come in and they're actually separate from the portfolio management team, and that's why we want to interview the portfolio manager separately as well as the ESG team, because sometimes you find out a portfolio manager is not using the information from the team who is evaluating the ESG risk. So it has to be fully integrated. And that's one thing we clearly look for. And that comes out in our ratings, and that's included in that dashboard that I talked about.
Yeah, really important to avoid what they call greenwashing, that disconnect. And I'm not saying it's intentional greenwashing. It could just be because there's a lack of communication. That's a new component to the management team. Russ, we're going to have to leave it there. We did not do this topic enough justice, but we will continue to talk about it, and we look forward to having you back on the program again very soon.
Great. Thanks for having me.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, so until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.